Hey, what's up, guys? Jeff Kamke here with Wealth Energetics. In today's video, I want to talk to you about a common Dave Ramsey belief that just is so pervasive. I see it all the time in Facebook ads that run from Dave, where you need 10 to 12 times your income in life insurance. And so we're going to dive into this. I want to share with you a different, enlightening perspective around this that's not going to be just so cookie cutter. It's not going to be so narrow-minded, so narrowly focused like Dave tends to be. And I'm not a big Dave Ramsey fan when he talks about life insurance because he's very misguided, very inaccurate in most things he talks about with life insurance, which is very sad since he's teaching to the Christian community primarily and the middle class working folks. And there's so many things that talk about with life insurance that I just don't even know where he's coming from. I think it's from very long time ago. So I want to shine some light on some of this. So let's just talk about life insurance in general. It's not a very exciting topic when you're looking at it from Dave Ramsey's perspective, but the way we teach about it is more from an infinite banking perspective, where in what the wealthy are doing to preserve and transfer wealth generationally, it is a foundational asset and it's used in a way that is unlike what the middle class are doing. We're writing a policy in a different way where we're getting different benefits out of the policy. It is something that moves with us throughout life. It is a very flexible asset. And traditionally, we're talking about whole life insurance as this foundational asset. Sometimes term insurance makes sense. There's certain situations where that does make sense. There's things called convertible term that you can go from a term policy if you don't have a lot of cash flow in the beginning to shifting that into a whole life policy later on within the first several years. That sometimes makes a lot of sense for people. But let me focus in on this whole 10 to 12 times your income calculation. Dave wants you to go look at term insurance because it's super cheap and whole life insurance is so expensive. And he's even equating it lately in some of his marketing to being on par with the payday advance type people, which I don't really know where he's coming from that exactly, but he's just trying to really throw shade at whole life. And he's missing a lot of the elements of where it's very foundational and very powerful for people. So the whole financial industry, when it looks at life insurance is looked at very narrowly. It's income replacement. That's the bottom line. So traditionally, Dave and a lot of the traditional financial experts will tell you that you only need life insurance maybe while you're early in your working career, while you have kids at home, and then once you've done buy term and invest the difference, and your portfolio is just blooming and blossoming with millions of dollars flowing everywhere, you're self-insured. And there's a lot of myths within that. And there's a lot of over-optimistic planning and thought processes is part of that. So if we're just looking at life insurance as a income replacement, it's an easy calculation. I make 100 grand a year. I'm 50 years old. I've got another 15 years that I'm going to be working. So maybe I want $1.5 million worth of death benefit. That's the end of it. So where can I go and get that $1.5 million for the cheapest? Because it's just another bill. That's the way it's looked at most of the time. And we're not looking at, can life insurance serve other purposes? Is there other benefits to it that make sense, that add things to our lives, that leverage money, that can protect money that would normally be another expense or another bill? You'd have to go hire another expert or another professional to do, where whole life can do that, all under the one umbrella. So as we're looking at just the death benefit, yes, whole life insurance is more expensive than just the death benefit. Absolutely, it's more expensive, but we're not looking at it from what's the cheapest way to be insured for our living or our death benefit, our human life value. And that's that calculation that Dave talks about, is 10 to 12 times, because you're only going to need that life insurance for a limited amount of time until you're just overflowing with so much money that you're self-insured. And there's a couple problems I have with that belief system, because that's assuming that if you buy term and invest the difference, because term is so cheap, but it's only in the first term. If you buy a 10 or 20-year term, yes, it might be very cheap depending on your age, but generally it's the cheapest it's going to be, because the closer you get to being a statistical probability of passing away, they're going to charge you more and more for that term insurance. So if you ever needed that first full term, and maybe your investments haven't blossomed, maybe the market's been down in several years, maybe life has happened to you, maybe you've lost your job, maybe you've gone through a divorce, maybe you've had, just a job change, maybe you had to relocate, maybe, just you had a health crisis. There's a lot of things that everybody goes through. I mean, I've had a full share of things happen in my lifetime that it derails your plan for success. And you think things are going to be at a certain point at a certain time, 5 or 10 years down the road. And guess what? You get there and like, gosh, man, that didn't pan out that way. So we have to stop planning for the best case scenario and making sure that if the worst case scenario happens or anything worse than the best case, right? Maybe medium, halfway to worse, but it's certainly not the best case, that our investments aren't flourishing or life happens, that I'm still protected for my human life value as just income replacement. That's just a straight up thing. If your family, your spouse, your family, your kids, or anybody else, if you have a business and you are employing other people, your value as a person, what you bring to the table, if you were to go away, a lot of people that are self-employed, they go away, so does their business. I know of a very successful construction company in my town that last I knew, he had trained nobody to do what he does as the owner of the company. So if something happened to him, the whole company basically, starts to probably slow down, if not shut down, because nobody's able to go get new business and do all that. He's only got laborers underneath him. So that is a thing that we need to look at, is if something happened to me, yes, I need to replace that income. And it comes down to the question of, if that happened to you, do you want your family to be in a worse position financially, to where there's a small amount of death benefit that just barely covers the bills for maybe 6 months or a year and maybe pays off the debt? Or do we want to be at the same income level that we've been at, that the family was used to being at? Or do we want to be in a better situation, because knowing that if we went through a tragic event like that, we're probably not going to be excited to go back to work. We're probably going to have a grieving process. If you've got family and kids, that can be a very difficult situation. And you want to be able to take as much time as you need to go through the grieving process. And I know some experts in the psychology world say that could be a 6 month to 12 month process of just going through the grieving process. Some people that could be slower or faster, obviously, but you want to give yourself the time and not feel like you've got to go back to work and basically bury those emotions. You can't process them through. And then years later, they surface as a health condition because you suppressed the grief, or you suppressed the sadness, or whatever emotions that are evoked from a situation like that. You want to be able to be in a position where you're covered with life insurance so that you don't have to go through that. And you can do the best you can based on the situation you've got, because money is not the reason that you have to go back to work. You've got the money part covered because your life insurance provided an abundance of death benefits. So it might be greater than that 10 to 12 times your income number that's right for you. And that's a big problem I have with Dave Ramsey of just giving a blanket statement, is he doesn't know you. He doesn't know your situation. He doesn't know what your goals are. He hasn't asked you any questions about, if this happened, what do you want things to look like? And how do you want to navigate this? And how much money do you want for your kids? How much money do you want your kids' college education to be covered? But if you passed away prematurely, would you want that to just be a no-brainer? My kids can automatically go there because of the death benefit. My spouse doesn't have to worry about that. I've up-leveled my kids. I've allowed my kids to take a step further into wealth and economic independence because of the death benefit that I had on my life. Yes, it covered my income, but it went so much further than that. That is a discussion we have with every single client, making sure that we're doing the right thing for you, the client, that aligns with what you want out of your life. And yes, financially, sometimes there's restriction. I can't afford a full-blown whole life policy that's going to do a lot of the tangible benefits, that's going to, be an alternative for a 529 college savings plan, or it's not going to provide that tax-free income stream in retirement, or it's not going to be the opportunity and savings vehicle that I have with a cash value of my life insurance. Maybe I do need to start with term or a convertible term. And that's okay. We're not like, it's got to always be whole life. There's definitely times and places for the term insurance, the convertible term, but we want to make sure that the death benefit is going to be there to do what you want it to do. And 10 to 12 times might severely undercut that. In that framework of 10 to 12 times, what if you have enough debt on your home or some vehicles or in your business that you get a death benefit that's 10 times your income, but half of that immediately goes to paying off debt, or 3/4 of that goes to paying off debt? Well, that's okay, but it's not putting you in a very ideal situation. It's certainly better than it could be if you didn't have any income replacement and you still had all that debt and your spouse needed to come up with all that. It's certainly better, but that may not be in alignment with what you want out of your financial strategy, your wealth strategy to be able to do for you. So that's a couple of the problems I have with it. And the whole idea that it's only term insurance is a very limited, way of going about it, because whole life can provide so many additional benefits. There's living benefits. There's issues that can arise, and this goes back to planning for the worst case scenario. What happens if you get disabled? What happens if you have a chronic illness or a terminal illness at the age of 45 or 50 or 60? That death benefit in a term policy, unless you have one of the very few carriers that offer living benefit term insurance where you can actually access your death benefit while you're alive to handle care and pay for things if you're terminally or chronically ill. Most of the time, a term policy is just income replacement. So the only way you get to actually utilize it is to pass away. Whereas a whole life policy, you've got living benefits. There are riders, at least One America that we primarily use, there's riders that automatically come on those policies that if you are terminally ill, chronically ill, you can have, or critically ill, you can have access to a percentage of your death benefit to maybe go get care, maybe to go find an alternative doctor that's going to be better than drugs and surgery and chemo and radiation if you have cancer or something like that. The story of my mentor, Chris, his father-in-law was diagnosed several years ago, I think 3 or 4 years ago, with stage 4 pancreatic cancer. Now, if you know anything about cancer, that's not the diagnosis you want. That is a terminal sentence. I think the doctors gave him just a handful of months to live. They took the access to the death benefit, the living benefits, went and sought alternative treatments, some very, very cutting edge doctors that aren't using drugs and surgery. They're using ways to find the cause of that pancreatic cancer, the mental, emotional, energetic reasons, the nutritional reasons, the toxins, the vitamin deficiencies, the food and dietary changes that need to be made, the exercise improvements that need to be made. They're looking at the whole person. And my mentor's father-in-law is still alive, playing golf 4 days a week after a stage 4 pancreatic cancer diagnosis. And literally the only reason he's still here is because of that living benefit rider that's attached to his policy that gives him access to that death benefit that he could go spend hundreds of thousands of dollars on top quality alternative medical care so that he's still alive. Otherwise, he would probably not be here because they wouldn't have had the money to do that. So that is one of the powerful benefits of life insurance that Dave Ramsey just completely overlooks. He doesn't understand planning for the worst case scenario, planning for contingencies. If things happen in life, what are you going to do about it? What is the best, most efficient way to handle that? And so that's part of what we're looking at in this whole discussion is we want to look at all those scenarios. We're not just looking at term life insurance as the cheapest alternative. It's the lowest cost bill to provide you this one use death benefit with life insurance. It's all the other facets that go into it. And I go into other videos on this channel about the benefits of life insurance and how we structure things differently. And you go look at those videos. I'm not trying to put all that into this video, but I touched on a few of the things that whole life insurance can do very, very well that you can't get out of literally any other financial asset or financial tool that does all the same things. You put $1 into a policy, it's that dollar is doing multiple things. It's giving you the death benefit, of course, but it's giving you the cash value is growing for you at an uninterrupted rate, which is to be compared with bonds or a savings account. Right now, we're in a rising interest rate environment where interest rates bottomed out a couple years ago, and now interest rates are going much higher. To get a mortgage, to get an auto loan, you're going to be paying 6, 7, 8, 9, 10% interest depending on your credit score. Whereas several years ago, or just a handful of years, 3 years ago, you're only paying a 2 or 3% for a mortgage, right? If you have good credit. So everything's changing. So right now in a rising interest rate environment, bonds are not very stable. They're not going to give you the high returns that they once did. That may change as the economy changes and different aspects change. But right now, a whole life insurance is comparable to bonds and a savings account. And you have money that's growing for you at a guaranteed rate plus dividends and in a tax-free environment. So the 3 to 5% you're getting out of the cash value of your life insurance policy, Dave Ramsey loves to knock on that. Like, I can go get 12% in a mutual fund. Well, Dave, that's before taxes. So you take 12%, take out 30% for taxes, you're down to what? 9%, basically, maybe 8%. Well, in a whole life policy, 3 to 5% is tax-free. So if you were to do the reverse math on that and what it would be to have it a certain amount of interest and then have the taxes taken out of it to get down to 3 to 5%, well, you're talking probably 5 to 7%. So, okay, for 1, 2, 3% difference of rate of return without the volatility of the markets, seems like whole life's a better option, right? Where I don't have to ride the emotional roller coaster of what is my money doing. You have knowledge, certainty, of what your money is going to do inside of a whole life policy. It's growing and you get access to that money. So the dollars are going in for the death benefit. You get access to a growing guaranteed cash value that's doing things to save you in taxes. Right now, I'm shooting this. We're right a few days before tax time here in the US. And, anything you can do to lower your taxation is a powerful thing. So that's a benefit. The money that goes into the policy is asset protected. That's a powerful thing. When you have a business and you want to protect your assets, just having money inside of a life insurance contract gives you asset protections. There's a few variances depending on what state you're in, but generally money that goes in there is asset protected from bankruptcy, liability, divorce, all those types of things, to where it's protected. You don't have to have fancy legal structures to protect that money. Now, you might need fancy legal structures, trusts, and other things to make sure that your other assets, your other monies are protected, but what goes inside the whole life policy is already protected. So that might get you going before you need some of the more advanced strategies of trusts and LLCs and S corps and whatever your person would recommend for your situation, right? So that's part of the benefit of the whole life policy. So we don't want to overlook those things and just solely focus in on, I need 10 to 12% of my annual income, and I want to find the lowest price possible because it's just another stinking bill and I hate my bills and I just want to, have that checked off and not looking at it that way. We don't want to look at it that way because that is a typical middle class money mindset where we're seeing everything with blinders on. We're missing the totality of how all moving pieces of our finances can work together, or they can work against each other in some ways, where money we have in our savings might be limiting the amount of money we can put towards investments or towards our retirement. Our money that we're putting into our retirement or our 401k is limiting what we can do in our business, right? Because we're diluting money out. We're always taught that diversification is so powerful because we're limiting our risk. Well, sometimes we're actually spreading ourselves too thin. We're diversifying out of synergy and diversifying out of having our money doing something powerfully for us where it can work together to grow and do multiple things with the same dollars. And that's one thing that whole life provides for us. So I think I've covered all the points that I wanted to make, but it comes down to asking the harder questions, seeing the bigger picture when it comes to talking life insurance, and making sure it's a right fit for you and your situation. The size is appropriate for what you want. Because I know many people that they're making more and more money. I know a colleague of mine recently, in the last few years, has dramatically increased his income. And if you were just to take a static 10 to 12% or 10 to 12 times income, 5 years ago for this individual, he would be severely underinsuring himself when it comes to where he's at right now, where he needs probably, 5 or 10 times of that again, what he would need right now to cover what he's been able to expand and grow in his personal finances. So that is a big key thing. And I did want to touch on one other point here about the self-insurance. So that's another myth that Dave Ramsey likes to purport, is if you have the low price term insurance and you're covered for just the first few years of your term, you put money in that 12% a year mutual fund that Dave loves to tout, that sooner than later, you're going to have millions of dollars and therefore you're self-insured. And that is a complete fallacy, because if he's purporting that or anybody else is purporting that, that is a marketing concept. That is not understanding what even insurance is, because insurance means you're indemnifying a loss, which in life insurance, you, the person, you have value on how much you can earn, right? That is your human life value. To insure something, if you were to insure your car or your home, and if that car burned down or got in an accident, your house burned down, there's a check that would come that would match the value at the time of the loss to be able to restore that. So our human life value is whatever that number might be, determined by the life insurance company. So for us to truly be self-insured, though, we would actually have to be able to do what an insurance company does, and that is insure the loss, your human life value. So if you're worth $1 million, then the insurance company would pay you $1 million. Now, we don't have to pay the insurance company $1 million to get $1 million of coverage, right? It's maybe if it's a whole life policy, maybe a few $1,000s a year. Obviously, if it's term, it's probably, $100 to $200, depending on age and what company and different variables. So you're paying pennies on the dollar for coverage. So it's a very efficient use of the few dollars that we're putting out to get many dollars of coverage back. So to be truly self-insured means you would have to have a mechanism that would allow you to put in $100 or $1,000 and get $1 million of coverage back out of that. And that's not what self-insurance is. Self-insurance is touted as being you have $1 million in a 401k or your brokerage account or in your savings account. And it really should be ideally savings, because if you're truly self-insured, it means you've got liquid access to that money. If your house burned down tomorrow, you could go get that money the next day and go start building a new house. That would be true insurance. But most of the time, Dave is talking about having that money locked up into some investment vehicle typically. And once you took taxes out of that, you're not going to have $1 million. So it's a false sense of security, really not truly insuring you, because you're not being efficient with the money that would take for you to truly have $1 million in an account, a brokerage account or wherever. And then if you passed away, your spouse could go access that money. Well, you're going to have probably early withdrawal penalties and fees. You have to pay taxes on that. So to actually get $1 million, if that's what your life was worth, out of a self-insured account, you'd probably have to have, $1.5 million or somewhere in there. You'd have to have quite a bit more to have taxes taken out, fees taken out to get back down to $1 million. And that's just not efficient for most people. It really isn't efficient for anybody. The wealthiest people on the planet, they have the best insurances because they understand money. They understand efficiency. They understand that if I can put in a few dollars and get a lot of dollars back out for a benefit, that is a better trade-off than having $1 million locked up that maybe isn't being utilized very well or very effectively to have liquidity to it, access to it when I need it. They just don't think that way. They know there's a better way. So don't get caught in the self-insurance trap. Now, it's okay to have savings. It's okay to have money set aside because, in the rare event that something happens, you need access to money. That's a good thing. But we love utilizing whole life insurance as cash value for the emergency fund and having money set aside, because a lot of times there's not that many things that happen that often where you need to go grab $10,000 or $20,000. Maybe some people obviously lose their job at times, or maybe have their hours cut and you need to go dip into savings. But a lot of times it's the bigger stuff that happens that people need access, not just to savings and liquidity to money, but it's the bigger things I already talked about with the chronic illnesses, the terminal illnesses. And what is your plan to do that? Because a lot of times when we get, my wife and I had an accident 6 months after we were married, and it set us up on a trajectory of debt. So it allowed us to find the things that we're teaching now, because it's what we applied in our life that made the difference. It got us out of, for what felt like me having to triple myself. I needed to pay off all of our debt. I needed to make money for the here and now to pay for our bills. And I need to plan for our future. I need three of me making 3 times the income. And then I realized, wait a minute, I could put money into a whole life insurance policy and be able to accelerate debt payoff, be able to have money reserved for when I need it. And I could be planning for my future for, a tax-free income stream in retirement, for long-term care strategies. I've got the boxes checked that if something did happen to me chronically or terminally, I've got access to that death benefit, because it's those types of things that can happen. The bigger hitting things that can really wipe people out, cause them to go into bankruptcy. And a lot of times the financial stress that can be so intense with those types of life events of like medical issues, that is what can a lot of times take people out even faster because of the emotional stress than whatever the disease was. Sometimes just the financial stress can be so overwhelming, it could just wipe people out and literally drain their life force to where they pass away, or at least accelerate everything we're talking about, the disease process plus the emotional stress. It can really be not a good combination, certainly not working synergistic on your behalf to promote health and healing and longevity, of course, right? So that is where we love the whole life insurance, to be able to do those mechanisms so that you're protected on a lot of different aspects, but the money that is going into it is being used extremely efficiently, so that you're covering a lot of aspects and you can sleep better at night. You don't have the subconscious thoughts of, oh, I wonder if this happened, what would happen? Or you hear, maybe you're driving on the road, you hear a radio ad for term life insurance and you kind of dismiss it because like, oh, I don't even want to think about if something bad happened to me. I'm not in a position to have those things taken care of. So you avoid it, right? It's very easy to avoid the things that we don't want to do. So if you're watching this and you haven't set up any type of life insurance on yourself, and you're getting the nudge that, maybe I need to take a serious look at this and figure out what I need to do to protect my family, but have all these other benefits in my life, because I need to plan for the worst case scenario. Click the link down in the description with this video. There's a link to my website, wealthenergetics.money. From there, you can also schedule a link. There's the direct calendar link in my description here, or through my website, you can do it as well. We can just have a conversation. We can get to know you, your situation a little bit better, find out what your goals are, see if what we offer is a right fit for you. If it's not, we are definitely not the ones to push something that isn't a right fit. That just goes completely against my morals and ethics on what we're doing here. So let's have a conversation if it resonates and we can move forward. Or if you're somebody that, you've already got life insurance, maybe you've got an IUL, an indexed universal life, you've got term insurance and you realize maybe that rule of 10 to 12x isn't enough. Maybe I've really increased my income a lot since then, and I need to add a policy or expand a policy or do just different strategies around it to make sure that I'm protected, make sure that I've got enough money growing, enough money in an emergency fund or an opportunity fund so that I can do the things in my life that I want to. Also, click the link in the description for my website or on the calendar link. Let's book a call. Let's talk this stuff over and see what we can do for you guys. So thanks for watching. If you haven't subscribed to the channel, please do so and like and comment on this video if there's anything that you want to talk about. I always get back to everybody that comments and make sure that we can create a dialogue and answer any questions that do come up. So thanks for watching, and we'll catch you guys soon. Take care.